Hey, good morning, everybody. Good afternoon, actually, now that we, at least for half the country, good afternoon. How's everybody doing? Obviously, I am not Scott. I'm filling in for my good friend and our CEO, Scott Bauer, today. And we are going to be talking about risk reversals. So just want to make sure that the video and audio are good. We should be okay. All right, good, good, good. Okay. First, I'd love for you to subscribe to our YouTube channel. Smash that like button. That helps us a lot in getting our message out here. So if you could just do that, that would be really, really helpful. Okay, so we are going to be looking at an example in Facebook for a risk reversal. We'll talk a little bit more about how, why, and when to use the risk reversal option strategy. Okay, so now a risk reversal, it can be bullish or bearish. In a bullish position, we're going to buy an out of the money call. We'll finance that buy of that call by selling an out of the money put. Conversely, as a bearish position, we would like to buy an out of the money put, and we finance that by selling an out of the money call. This first example would be bullish. Second example would be bearish. Now we're going to be using the same expiration and the same delta position typically. So if we're selling a 25 delta call, we're going to be buying a 25 delta put or conversely. Now, when there's a significant difference in the pricing or the implied volatility of the options, we're going to call that a implied volatility arbitrage. And let me bring up I'm just going to bring up a blank sheet of paper here. So when we're thinking about first thing that you should think is skew. Now, what is skew? We know that the implied volatilities of different expirations, the at the money implied volatility at different expirations, can be and often are different. For example, going into earnings, we're going to see short term implied volatility, that volatility level go up in general. So we're going to see that. So we know that in between different expirations, we're going to have potentially different implied volatilities. So let me just jot that down right there. But within that expiration, within, I'll just say any given expiration, the IVs of the different strikes can and will be different. Okay, and so I'm just going to put up here a typical equity skew curve. Pardon my bad writing here, but your typical equity skew curve will look something like this, with this being at the money. Okay, everybody with me on that? So we see that if this, lost my drawing tool here. So this is IV, and this would be price or strike. Okay, so we see that there are, now this is typical, it doesn't have to be that way, and we'll go over that, but we see that the typical equity curve has a higher value for implied volatility for puts than it does for calls. Now, why would that be? It's not random. Why are people more willing to pay in implied volatility terms for a put than a call? Well, maybe. I'm not even talking about earnings here, though, Aaron. I'm just talking, this is just what a general curve looks like. So think about it like this. The collective, not necessarily us personally, but the collective position in an equity, is it long or short? What do most people have in their portfolio? Do they have long stocks or short stock? Right. They're long. So in general, the public is long. Of course, there are people that can short stocks, but generally the position is long. So the laws of supply and demand says, okay, we have a collective population that is long the stock. So that makes them natural buyers of puts as protection and a natural caller or seller of calls because they have the underlying, they can do things like covered calls. They're not really worried about the upside. Also, the way that the market typically reacts to an up move or a down move, is it more volatile to the upside or the downside? Speaking in large terms. Exactly, Danil. More demand. So there are more people buying puts as protection against their long position, and they are selling calls as a yield enhancement, however you want to call it. So to the downside, on top of that, the market tends to move faster and more violently to the downside. In an upward move, it's much more measured. Sure, we can get moves of big moves to the upside, but in general, remember, that's what we have to keep in mind here. In general, we don't know what's going to happen 5 minutes or 5 days from now. But in general, so that's why we have what we call positive put skew. The implied volatilities of the puts are typically going to be higher than the calls. It's not always the case, but typically. All right, let me get rid of this. And let me get rid of that. Okay, so now this is an example in Meta. I think Scott put this together yesterday. So the stock is trading about 670. If we look at the expected move, it's about $50 on earnings. So now if we look out $50 above and be above the strike that we're at now and below the strike that we're at now, we see that the 720 call has a value of $8.05. And the 620 put, each of them are $50 away, we can look at implied vol terms, 113 versus 115. So here is where we're seeing something where there's actually call skew going into earnings. You'll see this. It's not typical, but at the very least, it's basically flat to positive call skew and actually negative put skew. The market is more afraid of a move to the upside than the downside. In this case, it doesn't always have to be like the first case that we did, especially going into earnings when you're talking about really a binary situation that you're going to be dealing with. So now we have the 720 call is approximately, that's what it seems like, John. They're buying more calls. So we have a $2 difference between two $50 out of the money options. Okay, so if we want to buy the put because we're seeing that's a lower implied volatility, if we buy the put at 605 and we sell the call, the 720 call, each of these are $50 out of the money, we would collect $2. That sounds like a good deal. But what is this position? Let me pull it up here. Sorry. The wrong thing here. Let me get over to Meta. It's not going to be exact because we put this together yesterday, and I'm going to need to get some more strikes in here. All of them. All right, and if we look at the 620, 720, let's look where this thing is right now. 620. So we're going to sell that, and we're going to buy the 720s. Won't be too far away from that. So it's not trading $2, it's trading $1.62. Okay, so now we have this position that we are collecting money. And actually, on this one, this thing flip on us? Now the call is above. All right, let's scrap the real-time one. This is where it was yesterday. Sorry about that. Okay, so if we had this situation, sorry, trying to get things set up here again. Okay. So we could collect $2, but it is 100% bearish. We're long put, we're short call. Yes, we get to collect $2, or at least we were yesterday. But we are 100% bearish, and remember, we are short this 720 call. What does that leave us? What's our risk to the upside? My risk to the upside is potentially unlimited, right? I'm just naked this 720 call. So if we go up to 1,000, I'm short from 720. Downside, we have no problem. Okay, so we see that the stock is 670, expected move is $5. We have about equal deltas here. Now, if we buy the put and we sell the call, that's a 40 delta between that. Does everybody see where that is? Because the 20 put is going to have and we're buying that. So that's going to have a negative delta. The 720 call, we're selling that. That has a 22 delta. So this spread together has a negative 40 delta to it. We're not doing this at the money. So if we do this 10 times, we have 400 short deltas. What if the stock goes down $50? We're short 400 delta. It's not getting better for us. If the stock goes up $50, excuse me, downside we're cool. Forgot we bought put short call. So if we go down $50, we're just naked short. All good. If we go up $50, now we have a problem with our short call that can potentially go to infinity. That's not great. So how do we get to a delta neutral position? After talking about the net deltas of these when we put the trade on or when we were looking at it was -40. What do we do? What can we do to make ourselves delta neutral? Buy shares. Exactly, Aaron. We can buy 400 shares of Meta, and then we're at least right here, we are delta neutral. Of course, that position is going to change as far as delta as the underlying moves. We're going to get shorter delta as we go down because of the puts that were long, and we're going to get shorter delta as the calls that we are short, that delta increase. But right here, it's a 40 delta. Should I stay or should I go? Exactly. If we sit right here, we collect that $2. If we go up or down a little bit, probably collect about the same. Because that skew has to go away at expiration. Right? The deltas are either going to be 100 or 0. No in between. So Scott was very cool and put up one of the great bands of all time, The Clash. Should I stay or should I go? But here we're looking at it, and we're looking at a situation that is a little bit abnormal in that there's more interest in the calls than the puts. I've seen this a couple times. Not typical. NVIDIA, we've seen it. We've seen it in MU. We've seen it in SDNK and MU. The margin will be high because you're going to be margin on that short call. The long put is no problem. That short call, you're going to be. I want to be sedated. That's the Ramones. That's not the Clash. I love the effort, though. All right. Word for today. That's right. They're not that far away from each other, TJ. Bye-bye is the word for today. Clearly in about an hour and 40 minutes, 40 minutes, Jerome Powell will have his last press conference as the chairman of the FOMC. Largely 100% says they're not going to do anything with rates. So the question becomes, is this going to be kind of a pat you on the back, thank you for everything that you've done type of press conference? Or is he going to kind of prophesize on what he hopes and what he sees for the FOMC going forward? I don't know if you saw this morning, Warsh did clear the Senate Banking Committee to have his nomination go in front of the full Senate. So unless there's something crazy that happens, he's probably going to be our new Fed governor. Now, Powell does have the ability to stay on. Warsh would be the FOMC chairman. Powell does have the ability to step down from the chairmanship and be just a governor. Typically, and I don't remember the last time that it's happened, and maybe somebody wants to Google it, that a chairman has stayed on as a governor afterward. I don't recall one. So we don't know. And so that should be interesting. Because we're not going to hear too much from him other than, sound bites that somebody grabbed from him. As far as him getting in front of everybody and saying, this is what my Fed committee is doing, this is the last time we get to see it. All right, did everybody get that? The bye-bye? I'm sure Mike is putting in these names right now. Anybody have any other questions while we're waiting for the wheel to come up? And I don't understand the question, spy. All right, Mike's putting the finishing touches on this wheel. There we go. I haven't seen any other questions come up here, but I really don't see a whole lot coming out. Maybe Powell decides to kind of let loose a little bit here. It's his last time. In the case of Meta, the double vertical may be cheaper than a diagonal strategy due to call skew. We weren't talking about either of those, but you would have the call skew on either side of that in a double vertical or a double diagonal. Can you buy one of the Prosper jackets? I don't think we sell them. We do give them to those that come in and visit with us for fly-ins, but I don't think we have them for sale. All right, hang on a second here. Mike just got our wheel of names going here. Let me pull this in here. And as you see, in the middle of the wheel today, who do we have? Mr. Lee Elia. Today is Lee Elia today. So if you are not a Cubs fan, you probably don't know what that means. I highly recommend Googling Lee Elia rant, E-L-I-A. Little rant from a Cubs manager from 1983. All right, here's the wheel here. Valerie Petushin. Why does a trailing stop limit order does not sometimes take, but a trailing? Well, because a limit order puts out a limit when it triggers, and if nobody buys it from you, then you just miss it. There you go, Valerie. Very, very good work today. All right, everybody. So in about 35 minutes, excuse me, we are going to have the decision And then we'll kind of trade around off of that, and probably not a whole lot from that because there's not a lot going on. And then we will hear from Mr. Powell, his final press conference as the Fed chairman. All right, I want to thank everybody for coming in here today. I really appreciate it. Remember, smash that subscribe button, smash that like button, do whatever you can to help us here. I hope you like the content. If there's anything that you guys would ever like to talk about, please email us here. We'll get it in here somewhere. We're always looking for something to talk about. So good luck with FOMC. Just realize that it could get a little bit wild. So I appreciate it, everybody. Have a great rest of the day. And like I said, don't try and be a hero during this stuff. Sometimes you just got to sit on your hands. All right. Thank you so much, everybody. And I will see you next time.